There was a Tuesday morning in a kitchen somewhere, in the middle of an ordinary life. A man sat at his kitchen table with a cup of coffee that had gone cold and a browser tab he had opened and closed 4 times in the past month. The tab was a simple investment account sign-up page. Nothing complicated. Nothing that required expertise or a financial advisor or a minimum balance that was out of reach. Just a form. A starting point. He closed it again. He told himself what had felt true for 3 years, that the market was uncertain right now, that he would start properly once things settled, that he needed to understand it better first. That next month, when the car payment cleared, when the holiday was paid off, when things felt a little more stable, he would sit down and do it properly. He was 34 years old. He had been 31 when he first opened that tab. What those 3 years cost him is a number most people never calculate. 3 years on a contribution most people could manage without noticing. The difference in final wealth is more than $800,000. This video is about that number, and about why the feeling that kept him from it felt exactly like wisdom. Before we understand what waiting costs, we need to understand why it feels so reasonable. The man at the kitchen table was not foolish. He was not lazy. He was not indifferent to his financial future. He thought about it often, more than he would admit to anyone, in the way that people think about things they know they should do and have not yet done. A low-level hum of awareness that sits beneath the daily routine without quite breaking through it. He had a stable job, a decent salary. He was not extravagant. He saved in the sense that money accumulated in his current account rather than disappearing entirely each month. He had read enough to know that investing mattered. He just never felt ready. And the reasons changed, which is worth noticing, because it tells you something important about what was actually happening. In the first year, it was the market, a sharp correction that every headline confirmed was the wrong moment to begin. The second year brought something more personal, a car repair, a job change, a period where any new commitment felt premature. By the third year, the reason had shifted to knowledge. The reading he had done making him feel less ready rather than more, because the more he understood, the more he saw what he did not yet know. 3 years, 36 months, 1,095 mornings. On most of those mornings, he had a reason that felt completely valid. There is a pattern that financial researchers have documented across decades of data, and it is not the pattern most people expect when they think about how investors lose money. Most people imagine that investors lose money by making bold moves, by speculating, by putting money into things they do not understand and watching it disappear. And that does happen, but it is not where the majority of wealth is quietly, invisibly, irreversibly lost. The majority of wealth is lost to hesitation, not to bad decisions, to the decision that was never made, to the account that was never opened, to the first contribution that kept getting pushed to next month, until next month had a reason of its own, and the months began to move faster than the reasons could be resolved. Consider 2 people. They are the same age. They earn similar salaries. They have similar expenses. The only difference between them is when they started. The first person starts at 25. They put in $200 every single month, without exception, into a broad index fund returning an average of 10% per year. They do not time the market. They do not stop when the market falls. They simply contribute every month and leave it alone. At 65, they have approximately $1,270,000. The second person waits, not forever, just 10 years. They start at 35 with the same $200 a month, the same 10% average return, the same discipline, the same patience. They do everything right. They just started a decade later. At 65, they have approximately $452,000. The 10-year delay on a $200 monthly contribution costs approximately $818,000. $818,000. Not from making a bad investment. Not from a wrong call at the wrong moment. From making no investment at all. From closing the tab. The man at the kitchen table had a colleague. She sat 3 desks away, had started roughly the same time at the company, earned a comparable salary, and had none of the visible markers of someone doing something dramatically different with her money. She drove a modest car. She brought lunch most days. She did not talk about investing. She had simply, 3 years earlier, opened an account and set up an automatic transfer, $150 a month. She had not thought about it much since. The man knew this because she had mentioned it once briefly, in the way you mention something mundane, and he had nodded and made a note to do the same thing, and then he had not done it. He did not think about her account often. When he did, he felt something complicated, not quite envy, more like the awareness of a gap that was growing in a direction he could not quite see but could feel, the way you can feel the temperature drop before you see the clouds. What he could not feel, because it is genuinely invisible until you calculate it, was exactly how wide that gap was becoming with each month that passed. Not dramatically, not in a way that showed up anywhere. Just quietly, arithmetically, with the consistency that compounding applies to everyone equally whether they are watching or not. There is something that separates the people who start from the people who keep waiting, and it is not knowledge. It is not confidence. It is not a superior understanding of markets or economics or the mechanics of compound growth. It is the recognition of one specific truth. There is no version of starting that feels completely ready. The person who started at 25 did not feel ready at 25. They felt uncertain, underinformed, convinced that the market was probably about to do something alarming, because the market is always about to do something alarming if you read enough about it. They started anyway, not because the conditions were right, but because they understood that waiting for conditions to feel right is itself a choice, and that choice has a cost that compounds just as reliably as money does. Think about what the people who built significant wealth over long periods of time understood that most people do not. Not one of them waited for certainty. Not one of them found a moment when investing felt risk-free. What they found, or what they chose to accept, was that the risk of being in the market imperfectly is measurably smaller over long periods of time than the risk of not being in it at all. This is what someone like Jack Ma understood in a different context, rejected from more than 30 jobs, turned away from the same university 10 times, 2 businesses that failed before the one that worked. He did not wait for a door to open. He understood that waiting for the right conditions was a way of never beginning, and never beginning was the only outcome he could not recover from. The investor who stayed through the worst market falls of the past 30 years consistently outperformed the investor who tried to time those moments. Through crashes and corrections and moments when every instinct said to get out, they stayed. Not because they were braver, because they understood what they were actually choosing between. They were not choosing between safety and risk. They were choosing between 2 kinds of risk. The risk of being in the market, which is visible and feels acute, and the risk of staying out of it, which is invisible and feels like caution, but compounds silently into the gap between what a person has and what they could have had. Back to the man at the kitchen table. On this particular morning, something was different, not in the markets, not in his financial situation. Something smaller than that. He had done the calculation, not in the abstract, with his actual numbers, his actual age, the actual amount he could set aside each month without significant disruption to his life. And he had looked at what the gap between starting today and starting in another year would cost him, not over his lifetime, but in that single year alone. In 1 year of waiting, at his contribution level, he was giving up approximately $11,000 in future wealth. Not today. 40 years from now, when it would matter most. $11,000. For 1 more year of waiting. He looked at the number for a long time. There is a moment that is hard to describe to someone who has not experienced it, when the abstract becomes arithmetic and the arithmetic becomes real. When the thing you have been telling yourself is a reasonable position to hold starts to look, in the light of actual numbers, like something else entirely. He opened the tab. He did not feel ready. The market had done something unsettling the week before. He did not foo. The market had done something unsettling the week before. He did not fully understand all of the options in front of him. He chose the simplest one, a broad index fund, an automatic monthly transfer, an amount that was slightly less than he had originally planned because slightly less felt manageable, and manageable meant he would not talk himself out of it. He pressed confirm. Nothing changed that day. Nothing visible. No number on a screen moved in a way that mattered yet. But something had shifted in the only place that mattered for what came next, which is the relationship between a person and their own financial future. He had stopped waiting. The framework this story teaches is not complicated, and it does not require expertise to apply. Time in the market beats timing the market. This is not a slogan. It is a mathematical observation that has held true across every major market over every long period on record. The investor who stays invested through bad years consistently outperforms the investor who moves in and out trying to avoid them. Not because the bad years do not hurt. They do. But because the recovery from bad years and the compounding during good years is more powerful than the losses avoided by stepping out, especially when stepping out means missing the best days, which tend to cluster around the worst ones. The person who missed only the 10 best trading days in the market over a 30-year period ended up with roughly half the wealth of the person who stayed fully invested throughout. 10 days over 30 years. The cost of trying to time the market is, for most people, the majority of their long-term return. What this means in practice is that the question is never whether now is the right time to start. The question is whether you are going to start or not. The market will always have a reason to wait. There will always be uncertainty. There will always be a headline that makes this particular moment feel like the wrong one. The people who build wealth over time are not the people who found the right moment. They are the people who decided that imperfect action today was worth more than perfect action at some future point that never quite arrived. $200 a month. From today. In the simplest, most diversified vehicle available to you. Left alone. That is not a sophisticated strategy. It is not the kind of thing that sounds impressive at a dinner party, but over 40 years at historical average returns, it becomes more than $1,200,000. From $200 a month, and the decision to stop waiting. The cost of starting is almost nothing. The cost of waiting is $818,000, and a morning at a kitchen table looking at a tab you have opened and closed for 3 years. The man who pressed confirm that morning did not become wealthy overnight. The account opened, the first transfer processed. The money went in and became a small position in a large fund and sat there, doing what money does when you leave it alone, which is grow slowly and quietly in a way that is entirely invisible until it is not. What changed was something harder to measure than a portfolio balance. He stopped waking up with that low-level hum, the awareness of the thing he had not done, the gap between what he knew he should do and what he was actually doing. It was gone, not because everything was resolved, but because the decision had been made and the direction was clear and the compounding had begun. Years later, if you asked him what the decision had cost him, he would not think about the money. He would think about the 3 years. Not with regret that was useless, with the specific, clarifying understanding of someone who has learned, at some cost but not the maximum cost, that the most dangerous financial position is not the wrong investment. It is no investment. And the most expensive thing a person can do with money they intend to grow is leave it sitting in a life they are planning to change when conditions feel right. Conditions never feel right. The tab is open right now. The question is not whether you know you should start. You already know. The question is what you are going to tell yourself today to close it one more time. Till the next decision, subscribe to this channel.